It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of A Bank Information. Take charge of your financial future with your personal bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show. I think it's pretty obvious, but if those that aren't aware of that, the key thing I think we need to be concerned about right now is the changes that are occurring going forward that are going to affect us financially, economically, our ability to, again, earn, keep, and pass on money. We're in the era of big government, and I don't think there's anyone that can argue with that point. And the big government actions are going to impact our money more than government, frankly, probably has in any time in history, at least the history of our country. I'll put it that way. So there were some messages I got from some folks recently that I thought was very I appreciate it. Number of listeners, like I said, I've been getting a lot of feedback from folks lately. Obviously, like I said, this is a financial show. That was the main focus, intention of this show from the beginning. And this past year, starting with the COVID lockdowns, those types of things, has required me, well, I guess it hasn't required, but certainly has impacted our money more than, well, at any time in my career. And I've been at this for over 20 years, working with clients, as a business owner, as an entrepreneur. I've owned 4 different businesses now: a retail business, a real estate investment business, a service company, and of course a financial insurance agency for the last 17 years now actually. And of course in the process of, I'm on the board of a bank in the process of starting a bank. I've got some exciting news on that front potentially, but it's premature. I can't share anything on that yet, but when that comes about, certainly I will. The thing is, actions by our federal government have caused impacts that are, or changes, let's put it this way, significant changes coming. We've had a situation over the past decade plus. I don't think anyone who remembers 08-09, the Great Recession, can argue the fact that that was a sea change economically. It certainly was. Interest rates were affected dramatically. Basically they went to all-time or near all-time lows, and for the most part have stayed there since. So our interest rate environment has been extremely low for the past 10 or 12 years. In fact, literally just yesterday, it was interesting. I was talking to a potential new client, and they just refinanced I think it was a 15-year mortgage, fixed mortgage at 2.5%. You know, those kinds of rates, not all that long ago, were completely unheard of. I mean, I still remember the days, and I'm dating myself a little, I guess, but it wasn't that long ago. Prior to 08-09, 7% mortgage was pretty normal. That was pretty common, and that was for somebody with good credit, okay, decent credit. So certainly our interest rate environment has changed dramatically. The other part of it is the Federal Reserve, after 08-09, became much, much more involved in monetary policy, more proactive than at any time, frankly, in their prior history, and have stayed very, very active in what they're doing in terms of particularly adjusting real interest rates. And secondly, the ease of money, how much money is available, or some people call it how much they print. They have printed an unprecedented amount of money. They've kept the interest rate environment at historical lows. I heard a while back, not too long ago, somebody was sharing that this is the lowest interest rate environment our country has experienced since 1787. That kind of puts things in perspective. I mean, that's the history of our country. So if you're looking for, like I said, fixed interest or fixed income type of investments, trying to retire on those kinds of things, it's extremely, extremely difficult. You need a whole lot more money. In fact, I heard an advertisement not long ago talking about 10 years ago or so, if you had $500,000 of treasuries, your average income from that would be about $35,000 a year. Today, that's about $3,500 a year. So it just kind of points out and shows where the interest rate environment and the Fed, a lot of people say don't fight the Fed, that's where that term comes from, has really, really impacted which asset classes, what type of investments thrive, and which ones suffer. Again, it appears increasingly likely, I talked about this in the last week's shows, that certainly taxes look to be going up in many, many different ways. And inflation certainly, not now, maybe not this next year or two. Most experts are saying in a couple of years that inflation is a much, much more likely thing than it was before. I've stated this in previous shows. You can't print $6 trillion of money or dump $6 trillion of money into the system in the past year, which is what the federal government has done so far, and not expect there to be any impact from that. There's going to be implications that are probably going to be significant. So again, how do we navigate this? How do we go through this situation? This, I believe, going to become another sea change, much like we saw in 08-09 with the Great Recession, where we saw a sea change in a number of things in terms of, 08-09, certainly real estate values took quite a hit, dramatically so. Stock market took a major hit also. Interest rates dropped significantly and have stayed pretty much low since. And, QE2 and QE3 and TARP and whatever else you want to call it, basically easy money or abundance of dollars, printing a lot of dollars has been the norm basically since 08-09 more than not, often than not. So these are all things that changed then. And we had to adjust, and those that did adjust, did well. I mean, if you look at, for example, the stock market the past decade, there's no argument it's done really, really well. Lots of money, easy monetary policy, low interest rates do tend to favor business. And that tends to favor the stock market and that kind of thing. So that was certainly a place to be. Like I said, fixed interest, fixed income, things tended to suffer because of the low interest rate environment during that same time. What's going to happen going forward? Well, there's no way to predict exactly what's going to happen for sure, but there's some macro or some major big things that can certainly be looked at, and we can look at some trends and determine what would likely be beneficial. Again, if we see higher taxes, that's generally not so good for business or not so good for the stock market, for example. Inflation tends to be better for tangible assets like real estate. Also, inflation creates higher interest rates, so your fixed income or your fixed interest type of accounts tend to thrive in those areas. Again, I've talked about this so many times. If you've heard the show before about your personal bank, one of the reasons I'm such a fan. And by the way, if you've missed it or you want more information, go to yourpersonalbank.com. You can look at review any of the previously recorded shows. There's topics on each one on the different things I talk about, how it works, uses of it, and various other things. Go and listen to some of the things that might interest you. There's a wealth of information there. And I can say this, and again, I've got so many compliments from this, and I appreciate this, that almost without exception, when I talk to somebody and then they go and listen to some of the previously recorded shows and get some of the other information from it, I get overwhelmingly positive responses. They find the information extremely valuable. They find it interesting. Sometimes, I'm not saying I'm a contrarian, but it's another point of view from what most people hear. And the reason why the viewpoints that I have maybe aren't what most people are familiar with when you're talking about the financial industry in general. is I don't really come at looking at financial solutions and financial products and tools and things like that, and markets and whatever. I don't really approach it from a financial advisor standpoint. Yes, I have licenses and stuff like that. I get that. But really, my background is as an entrepreneur. I've been an entrepreneur for far longer than I've been a financial person. So my training, my experience, my thought process really comes from being a small business owner. And I've had some successes. I've had some failures. And it's kind of interesting. You tend to learn more from the failures than the successes sometimes. Or certainly, I'll put it this way. You don't forget those lessons when you have a failure, right? So any small business owner kind of has to become a successful one, has to become a jack of all trades oftentimes. The common saying is you're a jack of all trades, master of none. Well, that's kind of false. You're a jack of all trades. You got to get pretty darn good at a number of them, or you're not going to succeed. You have to master several key ones. And if there's certain areas that you find are weaknesses of yours, then you better hire out or bring somebody on the team who's very good in that area where you're weak. That's how you succeed, as an entrepreneur. So again, economics, financial situations, all that are very much on the forefront of most small business owners. So it isn't new territory. But I guess my point is, I kind of got off track a bit there. The reason, and I guess in the next segment I'll have to touch on it further, why I'm such a fan of the Your Personal Bank concept is it works in various different economic climates. Particularly what we're looking at, I think, facing going forward as an outstanding diversification tool. Again, Your Personal Bank is highly interest rate sensitive. We have companies that have been paying 6%, still paying 6% even today, dividends, and have for the last 25 plus years. Now, when you look at the current interest rate environment and what it's been for the past decade, frankly, that's pretty incredible. But they pay even more and historically have done even higher when interest rates are more normal, more like 7-8%, by the way. I can show you the charts and show you the historicals over the last 25 years. And if we do get into a situation where we have higher interest rates, we have some inflation, it's very likely that Your Personal Bank might be one of the best tools, financial tools you own. So I'm going to really encourage you to contact me at yourpersonalbank.com for more information, and stay tuned in the next segment as we're going to discuss this further.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show, and today we're really talking about, well, how will the era of big government affect our money? I think it's getting more and more obvious that our government, well, certainly they've been spending a lot of money. $6 trillion so far this past year, talking about spending more. Inflation is becoming more and more of a concern. Many economists are predicting now that in the next year or two, we should start to see inflation. I think we're already starting to see some effects of it. I mean, look at gas prices. They've already jumped. The thing is about inflation, it's rather insidious. And what I mean by that is it affects pretty much everything, the cost of goods and services. And it affects nearly everything that people purchase, food, clothing, housing, gas, everything. So when folks say, this is free money, which that's another whole topic, the problem is then when there's more money in the system chasing items, goods and services, obviously those price of those items go up, and that's called inflation. So is it free money? No, we really end up paying more, and unfortunately all of us end up paying more, whether we receive a check from the government or not. That's a basic economics 101 lesson that, frankly, I wish more people understood. And it's a failure of our education system. It's a failure of our society that the majority of people do not understand that. In fact, I'm not even going to say the majority. I don't even think it's even anywhere close to the majority understand that basic economic fact. But here's the thing. I'm not here to argue that right now today. I've done that plenty of times on other shows. If you've listened, you know what I'm talking about. And I just want to say, and by the way, again, if you missed any previous shows, you want more information on how your personal bank works or how it can impact your financial future and give you more control of your money, reduce taxes, things like that, have access to the funds, create positive arbitrage, I'm going to really encourage you to go to yourpersonalbank.com and listen to any of the previous shows. I have topics on each of the previous shows, and some of them go over those very things. Really what I want to talk about today is how do we navigate this changing economic environment that we're seeing starting to change as we speak. In the last segment, I was talking about how 08-09 was a sea change in terms of economics, in terms of things like interest rates and monetary policy and things like that, obviously. I believe that we're looking at another equally impactful sea change, if you will, in our economic future and our economic situation as a country. And how does that affect our money? Of course, in the last decade or so, things that benefited from low interest rates and easy money did well. Real estate did well because of easy money. Low interest rates tends to favor businesses and the stock market and things like that. Things that tended to suffer more were fixed interest or fixed income type of assets because, again, they're interest rate sensitive. And with a really low interest rate environment, you talk to anyone today who's, say, retired and trying to live on any kind of fixed income, they can tell you the story. They're living it. It's been a struggle for the last decade or so to get a decent rate of return with some guarantees or safety. It's part of the reason why your personal bank has been so popular, because it's one of the few financial tools left that is interest rate sensitive, but yet still paying 6% even today dividends, and with guarantees and safety, and if set up properly, income tax free. So you can grow your money tax free, access it tax free, pass it on to your heirs tax free. That's very powerful. The thing why I am, again, such a fan of using this tool and why I share with it on the radio. We use other tools. We do other things. Don't get me wrong. It's not the only thing we do. I get asked that quite often. When other situations, other products, other tools come into play that make sense for you, certainly we'll bring that to your attention. But the personal bank tool is such a versatile tool in so many different situations. It held up quite well over the past decade plus in terms of generating a decent dividend with guarantees, safety, and tax benefits. Okay, well, we go back prior to 08-09, most of these dividends that were getting paid, I told you today they're still paying 6%. If we go prior to 08-09, most all these were paying in the 7-8% range. Again, it's all relative to interest rates. And then when you can access the funds from a bank line of credit, remember, we're using the bank line as the cash in the policy is collateral for the bank line, we gain positive arbitrage. And today, that positive arbitrage, the banks are charging between 3 and 3.95%, depending on the size of the account. And if you're earning somewhere between, say, 5.75 and 6% dividends, and you access the funds and you're getting charged 3 to 3.95, what's your money doing? And again, it's the difference. You're keeping the difference. You're keeping that 2 to 3% positive arbitrage. And remember, folks, this is the key on this. That's on money you spent. When I share this thought with people consistently, I get this response. It's almost universal. And that is, this was interesting when I first looked at it. And as we meet and they talk to me, and like I said, you can schedule a free consultation with me at yourpersonalbank.com. There's no cost or obligation to do so. The thing is, they invariably will say, wow, this is even better than I thought. I definitely can see where this is a tool I can use to enhance my financial situation. And the answer is that way, and so commonly that way. And the reason is because, again, this tool is so versatile. Again, if you're using this to enhance your rate of return on investments, well, you pick up an extra 2 or 3 positive arbitrage by putting the money in the policy first, gaining the dividend, then accessing through the bank line of credit and keeping the difference, therefore adding or enhancing your rate of return. Well, that's just a good thing. That's extra money in your pocket, right? If you're using this tool to reduce the cost of debt, reduce the interest costs on debt you're servicing, well, same thing. You have a choice. You can pay off the debt and the money's gone forever, or you can put it in the policy, access the funds from the bank line of credit and pay off the debt and still pick up the 2 or 3% positive arbitrage on the dollars you use to pay off the debt. Means you still gain interest on that money going forward for the rest of your life. Look, if you paid off a debt, you paid off the debt, didn't you? The debt's gone. That's a good thing. But the money that you used to pay it is gone also, isn't it? This way you're able to benefit at least some percentage of that for the rest of your life. And that can amount to a significant amount of money. So my point is simple, is irregardless of the situation or the scenario, almost without exception, we're able to increase or enhance somebody's financial position. And the last thought really is, today in particular, again, looking forward at most likely higher taxes in a lot of different areas. Well, here's a diversification tool. Here's a bucket where you can put some money into a bucket that's going to grow income tax free. So therefore, if they increase taxes and these taxes do indeed affect you, which frankly they probably will, why not have the option of having a bucket of money that you can access income tax free? Doesn't that give you options? Of course it does. It also gives you more control of your money, which is what I want to talk to you about next in the next segment. So please don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. And today we're really talking about how will the era of big government affect our money. The two things that I see coming down the pike, one in the probably near future, like next year most likely, is higher taxes. I don't think that's a big secret. The Biden administration has stated multiple times through multiple sources they intend to raise taxes. And they intend to raise taxes in a multiple of different areas in different ways. And my statement to anyone listening, if they think they're going to escape the effect of those higher taxes, whether they pay them directly or not, I'm going to say to you, you're sorely mistaken. Because if you just take the example of raising corporate income taxes, which is one of the main key pieces that's been discussed. Corporations do not pay taxes. I mean, technically, directly, they do write the checks to the IRS. But when a corporation or company their taxes are increased, all they do is raise the price of their goods or service, or they reduce expenses, or most often do some of both. So the bottom line is we end up paying more for the goods and services that we purchase. And it's not like you're going to escape it because you say, well, I just won't buy those items. I'm talking about raising the prices on things like food and clothing and housing and gas and everything else you can think of. So unless you live totally off the grid and don't use, that's about even then you're going to have higher property taxes probably. Who knows? Depends on where you're at. But the reality is it's almost next to impossible to escape the effects of higher taxes. Okay? And again, that's an economics 101 thing, basic financial literacy concept that, well, sadly, very few people really understand. And it's not that complicated. But I'm diverging here a bit. I'm really wanting to focus on what can we do? How do we gain control of our money again? I have this conversation on a regular basis, on a weekly basis. I had it twice this week with two prospective clients. See, here's the situation I run into quite often, the vast majority of the time, frankly. See, a lot of people who have put money away over the past decade or so have, from my experience, have put a majority, if not all, of that money into what we call tax-deferred type of accounts. Now, these are accounts like IRAs and 401ks and deferred comp and various 457 plans and TSAs, and they're under a number of different titles. But the reality is, from a tax standpoint, they all have the same tax consequence. There's one exception that I'll touch on in a minute. The tax consequence for all of these types of accounts, of course, as most of you know, is you defer the tax today when you contribute into it, I should say, and then you pay the tax when you withdraw or access the funds. The idea is typically you do that in retirement. The intention and the reasoning, the rationale we are get told most often is, well, you'll be in a lower tax bracket in retirement, so therefore you'll pay a lower rate. Now, I can cite study after study, multiple studies that have shown that for about a little over 80% of Americans, that tactic actually does not work. In other words, the majority of Americans, when they retire, end up being in the same tax bracket when they retire or higher than when they were working. Why? Well, things like Social Security benefits, pension benefits, IRA distributions, investment income, various things like that are all taxable. And depending on what they have and how it ends up, their income, they end up paying as much or more or being in the same bracket or higher. So from a statistical standpoint, frankly, for most people, it just doesn't work. The other thing I can share, personal experience, I work with a lot of retirees. I've been involved with this for 22 plus years. I can tell you, I can't think of a situation almost where I'm talking to a retiree who's now taking the required minimum distributions, which start at age 72 now, based on current laws, tax laws. And many times they're facing some pretty hefty tax bills. And I get the comment invariably from them is, well, if I had known how it really worked, I would have never done this. I've heard that so many times I can't even count. And see, the point I'm saying here is the key question you have to answer is it better to pay tax on the seed or the harvest? See, this is a hugely important question and is almost never asked or never analyzed or looked at because people just kind of do what everybody else does, or that they think that's just the way it's supposed to be done because they don't realize there might be another option. I'm going to talk further about this seed and harvest thing because especially now with tax rates most likely going up in the near future, this seed or harvest discussion is even more important than ever, so stay tuned.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
All right, we're rounding third, and we're going to finish this up today with the Your Personal Bank Show. And really what we're talking about today is how's the era of big government going to affect our money, and how do we navigate that? And I think the two big things that we really need to be concerned about are higher taxes. The Biden administration has come out very actively and in many different ways discussing multiple types of tax increases that will affect literally every American. If you don't agree with that statement, I'm going to challenge you and encourage you to gain a little bit of economic or financial literacy. Higher taxes affect everyone, not just the rich or not just businesses, because I'll use a quick and simple example. When a business gets taxed more, they pass on the extra cost to the consumer in the forms of higher prices of goods or services. They can reduce expenses too, which sometimes means loss of jobs and things. But the bottom line is the business doesn't pay the tax. The end consumer does. So if you buy anything, and corporate tax rates have gone up, you're going to pay more for those things. And what are we talking about? Things like food and clothing and housing and everything else that we all need and want. So yes, whoever you are, you will be affected by higher tax rates. Okay? Now, if you're an investor or you're trying to put money away for the future, that also affects your portfolio, your investments, what your money's doing, where it's growing. There's no question that the past decade or so, or certainly since the 08-09 Great Recession, we had a major sea change in terms of things like interest rates and monetary policy, where there was lots of easy money that the Fed has printed throughout the past decade or so. That allowed certain asset classes, things like the stock market, for example, to thrive. Real estate has also done well. Other areas have struggled. Particularly things that are interest rate sensitive, like bank accounts or CDs. Has anyone looked recently, or even the last few years, at the interest that you earn on your quote-unquote high-interest savings account or checking, or if you even get any interest? Or have you noticed even like what CD rates are at a bank? They're ridiculously low. Mortgage rates, never seen rates like this before. I have a client, a prospective client yesterday, just got a 15-year refi on his house, 2.5%. I'm seeing a lot of people getting mortgage rates in the high twos. I mean, that's a ridiculously low rate. Now, one of the things, again, your personal bank has done is it's held up extraordinarily well through this extended low interest rate environment. We have companies still paying 6% dividends, even today, and have been doing it 6% plus for the last 25 years, and have never missed a dividend since before the Civil War. Frankly, that's remarkable when you add on top of that underlying guarantees and, if set up properly, income tax free. And if you set it up with a bank line of credit, which we encourage, you can access and get charged a lower interest rate than what your dividends you're getting paid. So you get a positive arbitrage. And today that positive arbitrage is in the 2 to 3% and historically has been so. I'll discuss that a little further. But this is also very important because the first big issue with big government is higher taxes. The second issue is with easy money and the Fed policy and spending $6 trillion in the past year, for example, and projected to spend more. They're already talking about more. Well, that means there's more dollars in the system chasing items to purchase, which that equates to inflation. More and more economists are now coming out and stating they expect inflation to be higher, and they're having great concern about it in the next year or two. Now, I think it's already started personally. Look at real estate prices. Look at gas prices. I think the economists are behind the 8 ball on this, but that's neither here nor there. My point is quite simple. How do you navigate this, and how does this affect, say, your current asset allocation or your portfolio or your investments or your diversification strategy? In other words, what I'm going to say is, do you have an asset or a bucket of money, a chunk, in an interest rate sensitive type of investment? Is it one that has guarantees, so if there's a correction for various reasons, it's shielded from that? Do you have access to those funds without any penalties or restrictions or tax consequences? And when you do access those funds, can you still earn some interest on it, even if you use those funds and spend them and get some positive arbitrage? See, if the answer is no to any of those things, then I'm going to encourage you to contact me at yourpersonalbank.com and set up a free consultation or shoot me an email. My email is ferenc@yourpersonalbank.com. It's FERENC as in cat, no E. And if you want more information, I'll be happy to send it to you. But this is certainly worth looking at strictly for no other reason as a diversification strategy, as a income tax-free bucket, because if taxes go up in the future, this is going to be vitally more important, and as a safety or a hedge or a guarantee, a bucket that's not going to be subject to market risk, for example. You know, I failed to mention, and I should do, I've mentioned this book many times. It's called The Power of Zero by David McKnight. I have nothing to do with that book. In fact, I've recommended it to so many people. I should probably contact them about getting some kind of bonus. But anyway, whatever. It's an outstanding book. If anyone has an IRA or a 401k or deferred comp or any type of qualified plan, I strongly encourage you to read that book. It will open your eyes about taxes and the tax implication of those types of plans. And I can't not tell you how many times I've had folks who have then read the book and then contacted me and say, I read the book, we need to talk. You see, the premise of the book is quite simple. The power of zero means if tax rates double in the future, 2 times 0 still equals 0, doesn't it? In other words, if you have a bucket of money that's not subject to income taxes, irregardless of what our federal government does going forward in terms of tax policy, that bucket of money at least will not be subject to whatever that tax policy is. And my question is always, my statement is always this: doesn't it make sense to have a bucket of money where it's not taxable, not subject to federal rules and regulations like that, and you can access it if needed and get positive arbitrage at any time? Does that not give you options? In other words, if you have an IRA or 401k, or those types of accounts, we all know at a certain age, currently 72 for most people, you have to access the money and pay tax on it. Well, there's a certain amount, or you have to take, certainly, if you have one of those. But if you need or want more, you're going to, of course, pay tax on more, aren't you? Well, what if you had a bucket where some of it was tax-free and some was taxable? Could you adjust how much funds you took from each bucket each year, therefore adjusting the amount of tax you owed each year? Would it give you options? And the answer is yes, of course it would. Would it give you more control of your money? And the answer is yes. As I was starting to say at the beginning of this segment, I run into this so often that so many people have put the vast majority, if not even all of their money, into qualified plans, deferring their taxes, kicking the can down the road, in other words, and choosing to pay the tax on the harvest rather than the seed. I stated this earlier. Does it make more sense to pay tax on the seed or the harvest? Everything being equal, the answer generally is the seed, because the reason is simple. Do you want to pay tax on a small amount or later on a much greater amount? Now, again, the arguments are, well, you'll be in a lower tax bracket when you retire. I've stated earlier, I think in this segment or the one before, there's many studies that show that doesn't work for over 80% of Americans. So statistically, in most cases, that doesn't work. But even if it did, you're still getting paying taxes on a larger pile of money, aren't you? Are you going to pay more taxes overall? The answer in most cases is yes. Also, the other argument I get is, well, if I defer the tax now, I can invest that extra and make more going forward. Okay, that could be true. But can you tell me what the tax rate's going to be down the road when you do access it? And the answer, of course, is no one knows. Obviously, those rates are probably going to be higher now, aren't they? So what you're doing is you're deferring your tax now to, say, invest it to try to make a greater return on that, to then pay the tax later at a future unknown rate, which could easily be quite higher than it is today. Is that worth the risk? I can't answer that question for you right here on the radio. But is it worth having that discussion? Is it worth analyzing that and looking at the difference and seeing if you're willing to risk that, or does it make sense to take a portion off the table? See, when you're contributing to an IRA or a 401k, okay, the traditional ones, or deferred comp plan or whatever, many in our industry call those ticking tax time bombs, because that's exactly what they are. You're building a bigger and bigger bomb that's eventually going to blow up on you in your face, and you don't know how big that explosion is going to be, because you don't know what the future tax rate is going to be, do you? See, between you and I, oftentimes it really comes down to how much do you trust our Congress? How much are they going to let you keep? And I can make that statement even on a Roth, because why Roths are popular, of course, are a lot of people do Roth conversions because they want to grow the money tax-free for the rest of their life, because they do want to take that unknown tax liability off the table, that future unknown liability. So they'll pay the tax now to do the conversion to let the money grow tax-free for the rest of your life. But here I'm going to make a statement, and that's, I think, a general, again, depending on the situation, is a very good strategy. Certainly for a portion of your money, because, again, it gives you the option of a taxable bucket and a tax-free bucket when you take the monies out, right? But here's a statement I want to make that very few people think about. And the question is simple. Who created the Roth IRA? Or the IRA or the 401k or any of those for that matter? Well, it happens to be Congress. Can Congress change the rules in the future? The answer is, of course they can. Do you trust Congress enough today with your financial future, with your retirement? Only you can answer that question. And with the amount of money that our government has spent already for the past several decades, frankly, and particularly this past year, do you think they're going to be looking for sources of more money to pay some of that back, or at least pay the interest on that debt? They got to at least do that, right? So really the question is, do you trust our Congress with your retirement? Or in other words, how much of your retirement you're going to actually get to keep? Because do taxes make an impact on how much you get to keep on a traditional qualified plan? They can make a huge, massive difference. In fact, oftentimes, the number one factor in terms of how much you actually get to keep. It all depends on which bracket you're in. And what's the bracket going to be in the future? 10%, 20, 30, 40, more? Look at history. It's been much higher than that. If you want more information and you want to analyze this, contact me at yourpersonalbank.com. And I think you'll find our discussion will be enlightening, eye-opening, and whatever decision you make, at least you'll know what you're doing and why you're doing it. And I think that's what's most important. So stay tuned as always.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.